My name is Linda Meadley. I hold the life insurance seat here at Thrive. And today we're going to talk about life insurance. So we're going to get right into it. So life insurance. What is life insurance? Life insurance pays a tax-free lump sum of money to your named beneficiary in the event of your death. It's supposed to get you to the exact same place you were financially before the loss. It provides for your family when you are no longer able to do so. And it provides financial means for them to pay off debts, replace your income, so your family is able to maintain the same lifestyle. So with life insurance, there's two types. There's a term life insurance and permanent life insurance. And with term life insurance, it's meant to be cover temporary needs. It has an expiry and only goes up to the age of 85. It's most inexpensive with fixed premiums for the entire term. However, your rates will increase quite dramatically upon renewal. On the other hand, permanent insurance does not expire. It is in place for your entire life. It has a guaranteed payout. Premiums are fixed without payment options for life or 20 years. Policies with increasing cash values and increasing death benefits. So it's looked at more like an asset, right? Just a quick little visual. You can see that the term insurance starts out lower, set for a set period of time, which is your term, and then will increase. So if you continue to need the policy, it'll increase all the way up to age 85 and can get quite expensive in the later years. Permanent insurance starts out a little bit higher. However, it has level or stable payments throughout the entire contract, plus the added benefit of increasing death benefit and increasing cash values. So are you covered? Okay, life insurance, we all start with, when doing life insurance, we start with the needs analysis. Choosing the right life insurance policy and coverage can be very confusing and overwhelming for a lot of people. That is where a life insurance needs analysis comes in. A proper needs analysis will help ensure that I'm providing my clients with the appropriate coverage and the right insurance product. This builds trust and reduces the risk of clients misunderstanding what they have purchased. It's quite a basic formula. You've got your obligations plus your needs minus the assets equals your life insurance coverage. However, each client has unique needs and adjustments are made to meet those needs. So, new concept for some, life insurance for retirement income. How does that work? So basically, it's a concept to leverage the features of a permanent cash value life insurance policy to help provide additional sources of income during retirement. There's two phases. There's the accumulation phase. So while you're still working and you're building up your policy by maximizing the funding. And then the execution phase. At retirement, you supplement your income by accessing the cash values. Now you do this via loans, via the insurer, which would be us. You can do direct withdrawals of the cash as a surrender or secure a loan from third party, such as a bank, using the policy cash surrender values or death benefits as a security. So let's look at an example. How does that work? We're going to look at a male, 30 years old, non-smoker and in good health, a policy amount of $100,000, premiums of $343.98 a month, and he's only going to pay for 20 years. However, the policy will be in place for his entire life. After 20 years, no more premiums will be required, but the policy will continue to increase. So total premiums that are paid over the 20 years is $82,534. So this is what it looks like. After 20 years, the total cash surrender value is $97,887. The death benefit has now risen from $100,000 to almost $350,000, and the cost of the policy was only $82,000. So 20 years, no more payments. You've already made, if you were to cash this policy out, made more than what the policy you paid into it. Let's look at what that does for the future. So the future, you're looking at age 65, you had cash values of 251,000, almost $5,500 again, and you can see how it just compounds in the future years. So how much does that equate to retirement? So let's look at age 65. The 251,000 can add an additional $1,000 a month tax-free for a minimum of 21 years. It's going to last over 21 years, but that's the minimum it's going to go for. And at age 70, if you take that cash value, that's $13,000 a month tax-free, again for a minimum of 21 years. All your income that you're going to get, all your government pensions, any personal pensions, any RSP money that you have is taxable income. So it's great to have another source that's going to be non-taxable, as well as if you invest in tax-free savings accounts. That's my presentation. I thank you very much for listening to me, and I welcome any questions.